Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take you off course now to make it actionable, understandable, and clear. What a week, what a show. Fascinating articles. The news giveth. We are going to be looking at three. At the top, this is a friend of the show sent this to us, and boy, are we glad they did. Headlined, "When a crystal ball isn't enough to make you rich." I bet you've thought that before. If you just had a crystal ball, you could do it all. Think again. We'll tell you why later. The royal we. Up next, which countries have the strongest stock market returns? Guess again. It's a fascinating article in the Wall Street Journal by Mr. Derek Horstmeyer. You're not going to want to miss it. No surprise to you. It's paradoxical, the answer, and doesn't make sense at first blush. And then in closing, UBS. Here we go, UBS. They say that the U.S. economy is on the cusp of another roaring 20s. And they're not talking about the 1720s or the 1820s. They're talking about the 1920s, which I know I'm going to come out on a limb and say none of my listeners were alive then. Forgive me if you are. But we're going to look back and just see why UBS would say that and what we can take away from it. But at the top, when a crystal ball isn't enough to make you rich. I bet you thought it is. So this is by Victor Hagani, James White, and Jerry Bell. Fascinating. So they talk about Back to the Future. Now, you may be familiar with this, where Biff has the sports almanac, and he's able to see who wins the games, and he bets on them and makes $1 gazillion. Well, what if you, as an investor, had foreknowledge of what was to come to pass and could make investment bets accordingly? An experiment was run in November of 2023. This group of folks ran an in-person proctored experiment involving 118 young adults that were trained in finance. These aren't just, hey, I've read a book or so. These are like MBA finance undergrad folks who are serious about it. And they gave them a challenge. It's called the Crystal Ball Challenge. Everybody gets $50, and they can grow it by trading in the S&P 500 index and the 30-year U.S. Treasury bonds. And check this out, but they get the information that's on the front page of the Wall Street Journal one day in advance. None of the stock market data is there. It's all blacked out. But did you hear me correctly? These participants, and put yourself in their shoes, they get the Wall Street Journal a day in advance and then get to trade the S&P 500 and 30-year U.S. Treasury bond based on that knowledge. And it's effectively a 2-day out deal. So they would get to place their trades on Monday with Wednesday's headlines. Now, this game covers 15 days, 1 day for each year from 08 to 22. And guess what? If you want to check out the link, you can play this game yourself. What do you think, listener, the results were? Because I've always had this thought. I bet you have too. Oh, man, wouldn't it have been great if we could just know what was coming, trade on it? Check this out. Despite having the front page of the newspaper about 36 hours ahead of time, half of them lost money. These are sharp people. Half of them lost money. 1 in 6 went bust, totally bust, zeroed out, broke. The average payout was just $51. Reminder, they started with $50. So $51.62, a gain of 3.2%, which is indistinguishable from break even, according to the results. So can you believe it? That even having the knowledge ahead of time of what the headlines and information would be, folks couldn't make money. So the players guessed the direction of stocks and bonds correctly on only 51.5% of the roughly 2,000 trades they made. Ooh. They reference Lloyd Blankfein, the former CEO of Goldman Sachs, who tweeted one time that there are some trading days where if you had the news in advance, you really would have lost a lot of money. Sometimes the news is paradoxical. Tough to do. And it should give us a dose of humility and skepticism, Because wouldn't you know it, there are a whole host of investment theories and schemes and funds purported to outperform on the ability to know what's coming. But even the folks who knew what was coming couldn't trade appropriately on that information. Now, the actual sample of 118 folks that were staked $50 and proctored, they actually did better than the general population of 1,500 people who've played the game on their website, which you could be one of them. The median outcome for those players was a loss of about 30% of their money. Only 40% finished with a profit and 36% went bust. That's the general population. That's probably you and me. And just so you'll know, they actually went in and invited seasoned macro traders, professionals, a select group, head of trading at top 5 U.S. banks, top 10 macro hedge funds, senior traders at top 10 macro hedge funds. These are the best of the best. These folks finished with gains, so they got this information ahead of time. They actually saw their starting wealth. They grew by 130%, a median gain of 60%. They were where they were different than the finance students in the general population is trading size, the size of bets they made. So the veteran traders knew something about risk management. Isn't that interesting? However, what is the lesson to you? What is the lesson to me? Be very suspicious of yourself. Be very suspicious of what you think you can read in the tea leaves with today's knowledge. Not to mention 36 hours ahead of time. You still can't trade short. Short term is brutal. It is so tough. So have some humility. Be willing to play the long game, because you and I both know if we were to step in and say, what's going on here? Have you not heard? Do you not know? Have you not heard? We're instructed to keep our horizon long. Keep it long. They were not doing that. And even with a crystal ball, it was a struggle. A real struggle. Up next, Wall Street Journal. Which countries have the strongest stock market returns? Guess again. This is by Derek Horstmeister. Subheadline, you'd think that companies in countries that have strong GDP growth would be good places to invest your money. Not so. This is good data. Good data. He begins by saying many investors likely assume that if a country's economy is growing at a rapid rate, then the companies based in the country must also be delivering high returns. Do you ever think that? I can think that. It's logical. It's logical. GDP growth would trickle down, and the companies within that country would have robust profits. But alas, investing is more complicated than that. So this gentleman had research assistants, Nicholas Klein and Yashkaran Sidhu. They actually found the opposite to be true. Check this out. The countries with the highest growth rates in GDP, one of the broad measures of economic output, they're actually associated with the lowest market returns. Out of the top 7 fastest growing countries of the past 10 years, only one had a positive annual rate of return in the stock market. What? Well, how'd they figure this out? This group pulled monthly returns over the past decade for all country-specific ETFs for 34 countries. Those in Western Europe, Scandinavia, Asia, South America, U.S., Canada, Mexico. All the ETF returns were denominated in U.S. dollars, trying to make the comparison accurate across countries. Then they pulled the growth data on a quarterly basis for each country to get that GDP number. And what'd they find? When they looked at the 10-year average annual returns for each country, the countries with the highest GDP growth had the lowest stock market returns. What? The bottom quartile of countries in terms of GDP growth experienced an average annualized return of 3.42% over the past 10 years. In fact, and this is another surprise, in fact, just one of the top 7 countries had positive average returns in their stock indices over the past 10 years. China, Philippines, Vietnam, Turkey, Indonesia, Malaysia all averaged negative returns. India was the single high-growth country to deliver positive returns. And those high-growth countries come with more risk. There's more volatility. If you define risk by volatility, I understand the reason why people do. We're going to agree with them for now. Now, why is this? First of all, there's a lesson to be learned. Okay. If someone tells me to put my money in a country where the economy is growing quickly, I now know, wait a second, isn't there more to the story? There certainly is. Well, markets are dynamic. So what could be happening? Well, let's say the markets bid up the price of these countries in previous years. So the markets expected the high growth countries and their companies to grow at even higher rates than they did. And because they missed on the expectations, their stocks suffered. You see that happening. It's kind of like taking 1999 in the U.S., where we had such high expectations for earnings growth that if we just missed them, and we did, you saw the stock prices collapse from 1999 to 2003 and 2. So there's also the problem with some of these countries being developing countries is that, hey, the government sector can be growing quickly. It could be a lot of government spending. So those private companies don't always get to feel that tailwind. And sometimes there are currency things where high growth countries have a weaker currency, and so you're getting kind of a sugar high in the economic growth. It really isn't that helpful. So if you're a U.S. investor, and we are, you could be tempted to say, and this article actually concludes with something I'll disagree with for you, the listener. This is why you listen. He concludes by saying, all in all, if you're a U.S.-based investor who cares about dollar-denominated returns, then it may be best to avoid the high-growth emerging market countries out there. Yeah, I wouldn't go that far. What I think is interesting in these 10-year studies is they're just 10 years. We've got stock market data for a couple hundred years. While this, I think, is an article that's helpful in that it should humble us and make us think, I don't know which country is going to do best over the next decade. And at least it's paradoxical. At least it's not as simple as, show me the fastest growing economies. I'll just throw my money there. Because believe it or else, I've heard pitches like that. I have heard people in suits and ties at country clubs with seated lunches describe the reason to invest in those aforementioned countries, the Vietnams, the Chinas, the Philippines, as their economies are going to do great. So at least it's given us that kind of suspicion that, there's probably more to that. I'm not willing to go so far as Mr. Horstmeyer in saying you may want to avoid these countries. We got to be careful. As you know, I advocate for holding everything in a proper proportion, not knowing Vietnam could do great over the next decade. I don't know. China could do wonderfully. It is not in the past decade, but it could do wonderfully in the next decade. I simply don't know. But what I do know as an investor, I want to ensure that I keep my time horizon long. How do I do that? Well, I got to put my eggs in all the baskets. So that's my recommendation. Don't try and play the asset game. Be willing to spread out your bets so that you can keep your time horizon long and keep your investing simple. And now the costs are so low. Getting exposure. Ticker symbol VXUS. It's the Vanguard International ETF. It's going to have exposure to all these places in their proper proportions. Or if the one fund to rule them all, VT, Victor Tango, it's the total global. It's got US and everything else in it. One-stop shopping cheap. And in closing, this is a Fortune article. Headline, the U.S. economy is on the cusp of another roaring 20s, says UBS. This is by Eleanor Pringle. Whew. Now, you read an article like this, and what you first wonder is, has UBS always been talking like this? Because guess what? The article explains the European finance giant, UBS, believes Uncle Sammy, that's us, the U.S., is inching closer to a roaring 20 scenario, placing the likelihood of an incoming booming economic cycle at 50%. Whoa. The 1920s had the hallmarks of a strong economic cycle, a wider adoption of electricity and automobiles, as well as a post-war boom in consumption. That's World War I. So, and at the time, the average person may not have realized their luck. They're saying this could happen to us. This is Jason Draho, head of asset allocation at America's UBS. So even though economists are concerned about unemployment, recession, stagflation, this Jason Draho says the balance is only tipping higher toward a period of prosperity for Americans. So he says we're there right now. You're living it. Do you feel it? Do you feel the roaring 20s? Well, what I did for you, the listener, this is why the Robert Hunt Financial Market Update is just a little different. I went back and said, all right, UBS, have you always thought this? I did a quick search. Guess what I found? August 27th, UBS Wealth Management raised the odds of U.S. recession. Now, they raised it to 25% from 20%. What does that even mean? What does any of this data even mean? I have no idea. I don't know even how they think about it, because they don't say how they parse out the other things, but they were more worried in August. They were raising it. That's August of this year. UBS in December of 2023 said the recession will hit the U.S. in 2024. That's what UBS says. And so get ready for massive interest rate cuts. So UBS is telling us in December of 23, it's less than a year ago, hey, the recession's going to hit. Buckle up. And today they're saying UBS criteria to officially declare the roaring 20s is sustained GDP growth of 2.5% or higher, inflation in the 2-3% range, Fed fund rates of 3.5 and a 10-year yield of 4%. For us as investors, I would say whatever. Whatever. We are, of course, always interested to learn, but we're not taking the bait when a bank tells us this is it, now's the time. Because as we know from the previous article, GDP growth doesn't always translate into stock market returns. No. If it were only that easy. So your great economy may not coincide with a great stock market, meaning it's not actionable. Moreover, UBS could come out with an article a week from now with new data saying, 1931, here we come. We're back in the Great Depression. As an investor, we just don't know what's clickbait. You have to think there's a sales funnel going on here. UBS is just like any of the rest of us. They got to butter their bread. They got to bring in clients. A great way to do it is to make prognostications on the future, because the prospective client says, well, I don't know what's going to happen in the future. I need to partner with someone who does know what's going to happen in the future. Of course, you as a listener know it doesn't matter what you think about the future, or even if you know the future 36 hours in advance. Very difficult, very, very, very difficult to make money on that information. What matters, listener, is that you keep your cost low, your investing simple, and your time horizon long, because that's what's going to give you the best shot on your investing journey. Until next time.